Index-based ESG portfolios apply environmental, social, and governance considerations within a passive investment framework. Rather than relying on discretionary security selection, these portfolios follow predefined rules embedded within ESG indexes and benchmarks. The objective is to combine the cost efficiency, transparency, diversification, and scalability of passive investing with sustainability objectives. As ESG investing has grown, index providers have developed a wide range of ESG benchmarks that incorporate screening, ESG ratings, climate metrics, thematic exposures, and sustainability objectives. Managing index-based ESG portfolios requires careful benchmark selection, methodology evaluation, and ongoing monitoring to ensure alignment with investor goals, risk tolerances, and sustainability expectations. One common approach involves exclusion-based ESG indexes, which remove companies, sectors, or issuers that fail to meet specified ESG criteria. Typical exclusions include controversial weapons, tobacco, thermal coal, gambling, severe environmental violations, or breaches of international norms. Portfolio managers track these indexes by replicating their constituents and weightings. The primary benefit is simplicity and clear alignment with ethical or sustainability preferences. However, exclusions can reduce diversification, increase tracking error relative to traditional benchmarks, and create unintended sector or factor exposures. Portfolio managers must therefore balance sustainability objectives against portfolio efficiency and benchmark performance considerations. Another widely used approach is best-in-class or positive alignment indexing. These strategies maintain broad market exposure while selecting companies with stronger ESG performance relative to industry peers. ESG ratings are used to identify sector leaders, allowing portfolios to preserve diversification and sector representation while improving overall ESG characteristics. This methodology is often attractive to investors seeking ESG enhancement without dramatically changing portfolio risk profiles. However, results depend heavily on the underlying ESG scoring methodology and data provider. Differences among ESG ratings can lead to variations in index composition and sustainability outcomes, requiring investors to understand the benchmark construction process thoroughly. Climate-focused and sustainability-themed indexes represent another important category of index-based ESG portfolios. These benchmarks target specific sustainability objectives such as carbon reduction, net zero alignment, renewable energy exposure, clean technology, water management, or other environmental themes. Portfolio construction may involve carbon intensity targets, climate transition metrics, or exposure to companies benefiting from sustainability trends. These strategies allow investors to express specific sustainability views and align portfolios with long-term environmental objectives. However, thematic indexes may introduce concentration risk, higher volatility, and greater deviations from traditional benchmarks because of their narrower investment focus and sector exposures. Portfolio optimization techniques play a significant role in managing index-based ESG portfolios. Managers may target improved ESG scores, reduced carbon footprints, or enhanced sustainability characteristics while controlling tracking error relative to a parent benchmark. Optimization models balance ESG objectives against diversification, liquidity, turnover, sector neutrality, and risk constraints. Climate scenario analysis, ESG factor models, and quantitative portfolio construction tools are increasingly incorporated into passive ESG management processes. These approaches seek to improve sustainability outcomes while maintaining investment efficiency and minimizing unintended portfolio distortions. Successful implementation requires reliable data, robust methodologies, and careful monitoring of portfolio exposures. Despite their growing popularity, index-based ESG portfolios face several challenges. ESG data remain relatively immature, with limited historical records, coverage gaps, inconsistent disclosures, and low correlations among ESG rating providers. Different benchmark methodologies may produce significantly different portfolio outcomes, even when pursuing similar sustainability objectives. Investors must therefore evaluate index construction rules, data sources, ESG definitions, and performance trade-offs carefully. While passive ESG portfolios provide efficient access to sustainable investment strategies, they remain dependent on the quality of underlying datasets and benchmark methodologies. Effective management requires ongoing assessment of both financial performance and sustainability outcomes to ensure that portfolio objectives continue to be achieved.